Good afternoon, ladies and gentlemen. Actually, as a China local investor, I think today's my share will be helpful for the investor here who have and will have positions in China market. So actually, our topic today is embrace China's new normal by seizing growth investment opportunities. So first of all, it's a very brief introduction of myself. Actually, I've been working in China AMC, which is the one of the leading asset managers in China, and we manage over like 2 trillion RMB's AUM, focusing on equity, fixed income, and ETFs in China. So actually, we are the subsidiary of the Citigroup, which one is the largest security companies in China. So actually, we're the SOE company, S0, okay. So here's some awards we won, and we cooperate very closely with RHB Asset Management since 2018 to set up this fund, Shura China Focus Fund. And okay, we go to the second part, which is the economy in China as well as the market. Because I think during the last 2 or 3 years, investors could focus on the China market should feel quite challenging. It's also the same story happening in us. So here shows what happens in last year, because after reopen, investors, they all have the very high expectations on the performance of China's economy as well as the market. But actually, if it comes to the end of last year, you will find it's still quite disappointing. Okay, so this 3 chart shows that such kind of the process, what's going on in last year's market. And first of all, it's the GDP actually at the start of last year, we think the scenario should be US recession and China's recovery, especially after the withdrawal of COVID-0 policy. But actually, since Q2, China's GDP growth reached the peak. And after that, actually, we see that a revised down of the China GDP growth. But US side, actually, due to the very aggressive fiscal policies by US government, actually, the performance is really better than expectations before. And also, we find the same story happen to the CPI and real interest rate in China and in the US, okay? And since Q2 in China, we saw a declining CPI led by a fiscal contraction. But for the US side, actually, the CPI and PCE keep very good levels. Actually, it pushed the Fed in actually do more interest rate hike in last year. So that a very strong performance in their 10-year Treasury bond ratio. But actually, I think this scenario happening last year won't last in this year. So probably we will see a periodic improvement on China's growth expectations could happen. And before talking about China, we briefly show our views on the US side this year. Although the inflation began to fall in last year like Q4, but we saw that the US economy is still stronger than expected. So looking forward to this year, last year, I think the main driver for the US economy comes from very aggressive fiscal policies or expansion. But for this year, it is the re-election year for US. We believe that US fiscal policy will be more conservative, so that will lead to declining deficit rate in US. And this chart shows different investment banks, their expectations on the real interest rate for US this year. We can see it is a range from like 3 to 4.5. But that is the figure by the end of November last year. And we have already saw that the interest rate in US actually declined further than expected. So it's declined from over 5% to lower than 4%. So actually, they all began to revise down their expectations. So we believe under such kind of scenario that emerging market in this year in 2024 will have a better performance under such kind of the interest rate downside cycle of US. And then this chart shows that currently the dot plot suggests there will be like 2 to 4 times interest rate cut this year. So that will let a lower US dollar index. Represent the offshore market liquidity outside of US will improve. Then we come back to China, okay? Actually, in last year, we believe China's economy faced more difficulties than expected. Even though from the data perspective, we saw some resilient but still lacks clear highlights. So the left chart shows that we calculate China's GDP growth in 2 years horizon. Okay, there's a compound ratio that was only like 4.2% in less than 2 years. So actually, it was lower than the intrinsic trend of China's growth for last like 5 years or 10 years. The right chart shows that from a 3 years average or 4 years average level, it all shows that even the recovery in China last year above 5%, but actually still below the average level. So actually during the 3 parts of China's GDP, consumption, investment, as well as export, actually investment and export did not well last year, especially investment. We saw that continuous decline in real estate market. And export actually, it's mainly due to the changes of the counterparties of China's export. Because probably 3 years ago, the biggest counterparty of China's export was US. But if you look at the last year scenario, Asian countries such as Malaysia, Vietnam, and other emerging markets became the first of the biggest counterparties of China's export. And such kind of the weight will continue to boom up in next few years. And actually, what on earth led to a poor performance of China's economy last year? I think it is the fiscal, expenditures by Chinese government. Because orally, actually, Chinese government, they emphasize they have the active fiscal policies for last few years. But actually, the January figure shows that the broad fiscal expenditure declined in last year. So actually, it was the fiscal contraction rather than expansion. So we can see the second chart. It shows that even the official deficit ratio in China went up from like 3% to 3.8%, but the overall or general fiscal deficit ratio include the provincial level government's deficit ratio decline, okay? So that led to a poor performance in pricing index such as CPI and PPI and also PMI. And we all know that majority of Chinese listed companies have relations with the manufacturing sector. So actually, a poor PPI and a poor PMI will lead to a poor performance in the earnings growth in China. But we have already seen the active side or active signs, signals back into last month in December last year. Because if we have the memory between like 2015 to 2018 or 2019, China actually did a lot of boost on the real estate market by doing the monetary replacing of housing by those rebuilt areas or rebuilt projects. So a very useful tool then was the PSL. It was a very powerful monetary tool led by the US government. But since 2019 till 2023, last year, actually such kind of the policy or such kind of useful tool was stopped. But actually, since last year, China government, they began to reuse such kind of powerful tool, and it has very, very positive and very big leverage effect. That will boost, of course, the fiscal expenditures of China's government. And then when it comes to the liquidity in China, actually, China financial market liquidity is always sufficient, okay? There's a lot of money or liquidity among the financial system. But actually, from the right chart, it shows the gap between M1 and M2. The M1 figures shows the working capital of the enterprises in China. Since last year, actually, it kept declining. So that means that the confidence of the enterprises in China keeps quite low. So actually, we would like to see if there's a possibility or high possibility in this year, actually the M1 figure can catch up. The gap between M1 and M2 will narrow, so that will represent the real recovery in the real economy in China. But the gap between M1 and M2 goes wider, means that more money actually stay between the intra-bank systems in China, not going to the real economy enterprises to be the expansion of their business. So a very quick sum up on what's going on China's economy. First of all, is looking ahead to this year. We believe that under the low base, China's real GDP growth will be set around like 5%, and with the CPI, PPI, those pricing index will be stabilized. So it will change from last year's very trough scenario, like below 0 to 1.7 and 0.4. So actually the pricing index, if such kind of a figure below 0 turns to a negative value, the investor will have the concerns on the deflation risk in China. But actually, if such kind of thing can happen, it means that the value goes back to the positive value. Usually, actually, the investor will be more, comfortable with the expansion of or appreciation of the asset class value. Then, the decline of property investment actually will narrow, in our point of view, in this year due to the low base and relevant industry supporting policies. Actually, China property market hit the peak back into 2021. The new house sales that year was as high as 1.8 billion square meters, but after last 2 or 3 years, the leverage process, actually in last year, the new house sales in China was only like 0.7 billion square meters. Actually, within last 3 years, it's down by over 50%. And according to our research and different kind of calculations by bureaus in China, we think the average or mid-level of new house sales should be like 0.9 billion square meters. Actually, last year's level was already far below the average level. So such kind of low base, as well as supporting measures, can help the real estate market in China to stabilize in this year. And then export, actually, as emerging market became the biggest counterparties of China's export, we believe in this year, China's export still have some possibilities to achieve the positive gain. And then consumption, of course, is still able to contribute an important increment to China's economy. Then, from liquidity perspective, we will closely observe the M1 level to see whether such kind of recovery can catch up. And this chart shows as the world's second largest economy, China still maintains a medium to high growth rate. So actually compare with a lot of regions, especially those big economies, it's still quite attractive to investors. So actually this is the GS expectations for China's economy as well as some other parts of the world. So among the emerging market, especially under such big scale of economy, China's performance in the next 2 years still like 4.8 or 4.2. But I think for this year, actually the target for China's government will be set around like 5%. Then we come to the market performance. As we all know that in last year, China market, equity market actually are the worst performing equity market. But after consecutive 3 years derate in valuations, the chart below shows that now the China market is extremely cheap in valuation or extremely attractive in valuation. And we can see that India and Japan market, actually their performance is really well, really good last year. But after the re-rate, we have already seen that Japan equities, the valuation, have already surpassed its average range in past 20 years. So it is record high. Even though we can a debate that's still room, right? It still have the momentum, but it's hard to do very, surely confirmations that Japan will still perform very, very well this year. But for China, even have a lot of uncertainties, but under such low valuation, still have the possibility or high probabilities to turn around in next few months. And then we come to even break down the performance of China equity market in past 15 years, because we usually can earn two kinds of money. One is the valuation change, and the other is earnings growth. So actually, in last 3 years, Chinese stock market has been derate, and the valuation has been going down for 3 consecutive years. So in last 20 years, we never seen such kind of long-term, longer than 3 years derate. So I think under very low base, under low valuation, we have high probabilities that for this year, we will see the marginal rate in terms of valuation. And then another important reason why China's stock market performed poorly last year comes from the revised down of earnings growth, because at the beginning of last year, the consensus of earnings growth of Chinese economy, listed companies were 10%. But actually by Q3 last year, the consensus be revised down to -5%. So there's a gap between the beginning of the year and the end of the year. So actually, there's no surprise that China market down by 10% or 15% last year. But scenarios will totally change this year. According to our top-down measure, that all China equity market listed companies' earnings growth in this year will be around 5% or even higher. So listed company earnings growth that will lead to a re-rate in terms of the valuation. So actually should be a double beat. And we usually use this efficient ratio of the stock bond yield spread in China to show the attractiveness of equity market and fixed income market. Actually, if this figure goes down to -2 standard deviation compared with its mean level for last 2 decades, it usually indicate a very strong pull to the bottom range in China equity market. It is very efficient in past 20 years. And this time, we came to -2 standard deviation compared with this mean level. So actually, I believe, as I mentioned, those improving macro earnings growth will stimulate the risk appetite and also the performance of equity market in China this year. And that will drive the market recover from now very tough scenario to normal. So what does it mean? It means if the ratio can go up from -2 standard deviation back to +1 times standard deviation, that will indicate over 15% of upside in terms of the valuation. Okay. So also we did some sum up on this part on the market. Currently, I believe that the China equity market benefit from the overall improvement in domestic fundamentals, capital, and policies, and under the strong effect of continuous improvement on demand and profit margin this year, I think the turning point of corporate earnings growth will happen in this year. And also, I think that China equity market capital flows in this year might be reversed, turning from a net outflow to net inflow. That would be much more helpful for the performance of China equity market. So based on the optimistic view on the economy and market performance, actually, as the Shirai China Focus Fund, our fund actually will be bullish on the following investment opportunities in this year. First of all, it's quite similar with previous investors or professionals talking about. Actually, we are also optimistic on the AI industry trends in China. because according to our framework, actually, we like those fast-growing sectors with low penetration rate in China. So AI actually meets such kind of criteria. It has low penetration rate both in China and the US. And also the supply chain names, especially those hardware companies, most of them, they lie in China, okay? So actually, we can find opportunities within the hardware capex and also some software applications, okay? Then the second opportunities might come from the humanoid robotics industry. It also has the same pattern with AI, and also it is correlated with AI development. It has low penetration rate and also fast growing, and addressable market is huge. And we believe the rapid development of AI has brought a leap in perceptual level. And also, the key player in this area, Tesla, has led the industry from prototype to industrialization. And also, that will directly benefit China's supply chain, because during the EV era, the Tesla's supply chain or providers mainly comes from China, like Sanhua, Topo, those tier one. So actually, they also contribute a lot. One Tesla developed is humanoid robotics. Then the third opportunity, I think, comes from the acceleration of semiconductor localization in China. And one big signal comes from Huawei's back, okay? Huawei actually back since Q3 last year after it solved the difficulty or problems with the chip supply. So actually, after that, we saw that all product lines, like cell phone, like autos, and like telecommunications, actually Huawei's back. I believe that Huawei and its fabs as well as partners will do more capex on the capabilities in terms of semiconductor in China. And also besides Huawei, we saw that two very big memory chip makers like Changchun and Changxin also did very big plans to expand its capabilities in China in this year. So there's some data I need to mention. For example, in Q3 and Q4 last year, the total market of semiconductor equipment globally, China accounts for more than 40%. So it means that even their cycle of upside and downside globally in terms of semiconductor. But within the most recent years, like last year, year before last year, and this year and onwards, China will be the main driver of the semiconductor equipment globally. So that means that those local equipment and material providers will enjoy a very good time to deliver the result, as well as to take the original market share taken by those US companies as well as those European companies. So those semiconductor names in China will enjoy, like, I think 3 to 5 years valuation premium. That'll be good for us to invest in those names. And then is the consumption, okay? As we all know that last year, the CPI ratio declined. So actually, the performance of consumption sector is highly correlated with the CPI. So we believe that CPI will catch up in sometime this year. So actually, after that, we'll increase our holdings in consumption sectors, because I still think that consumption contribute a lot in China's economy. And the last one is healthcare, because China government actually take the anti-corruption action in healthcare sector last year, and they're highly probable in Q2 this year, such kind of anti-corruption in healthcare sector will come to an end. So we have already seen such kind of big potential of turnaround in healthcare sector, because the aging trend is still very clear in China. So I think the healthcare sector will benefit from such kind of a long trend. So this is my part. I hope that the investors here, you may have a good harvest in 2024. Thank you.